Have you ever wondered how central banks, like the Federal Reserve, fine-tune the amount of money flowing through the financial system every single day? It is a delicate balancing act, crucial for keeping our economy stable and running smoothly. At the heart of this daily balancing act are two powerful and flexible tools: repurchase agreements, commonly called repos, and reverse repurchase agreements, or reverse repos. They are essentially short-term loans, typically overnight, where securities act as collateral, allowing central banks to either inject or withdraw liquidity from the financial market. Let us break down how each one works. A repurchase agreement, or repo, is when a financial institution, like a bank, sells securities, such as United States Treasury bonds, to the central bank. Crucially, the institution simultaneously agrees to repurchase those very same securities at a slightly higher price on a specified future date, often just the next day. This transaction effectively provides the financial institution with cash from the central bank for a very short period. The central bank is lending money to the bank, with the bonds serving as ironclad collateral. Conversely, a reverse repurchase agreement, or reverse repo, is the exact opposite. In this scenario, the central bank sells securities to a financial institution and agrees to buy them back later at a slightly higher price. This operation effectively drains cash from the financial system. The financial institution is temporarily lending money to the central bank. The difference between the initial sale price and the later repurchase price in both these agreements represents the implicit interest rate of the transaction, often referred to as the repo rate. These mechanisms directly influence the availability of money in the economy. When the central bank conducts more repos, it injects cash into the banking system, increasing the money supply. This typically leads to a decrease in short-term interest rates, making it cheaper for banks to borrow from each other and for businesses and consumers to access credit. Conversely, when the central bank conducts more reverse repos, it removes cash from the banking system, reducing the money supply. This tends to push short-term interest rates higher, making borrowing more expensive. Central banks frequently use these operations to guide the federal funds rate, which is the interest rate at which commercial banks borrow and lend their excess reserves to each other overnight, towards their target range. Repos and reverse repos are core components of a central bank's open market operations, which are its primary means of implementing monetary policy. Beyond just influencing the overall money supply, these facilities also act as crucial backstops for the financial system. For instance, the Federal Reserve operates a standing repo facility and an overnight reverse repo facility. The standing repo facility allows eligible institutions to obtain overnight loans against collateral, ensuring they always have access to liquidity when needed. The overnight reverse repo facility helps set a floor for short-term interest rates by offering a secure, short-term investment option for money market funds and other institutions. These facilities provide stability by offering a predictable outlet or source of cash, helping to smooth out daily fluctuations in market liquidity. So, while repos and reverse repos might seem like technical financial jargon, they are incredibly vital instruments. They provide central banks with precise, flexible control over short-term interest rates and the money supply. By skillfully deploying these tools, central banks can effectively manage liquidity, maintain financial stability, and subtly guide the economy towards desired goals, all through the simple yet powerful mechanism of temporary collateralized security exchanges. It is a testament to how sophisticated financial engineering supports the macro economy.